Hey everyone, welcome back to Chipstock Investor.
Software edition, enterprise software edition.
Ooh, exciting.
Exciting, ominous, even.
We're going to be talking about Snowflake today. And if you've been following us for this last year, you may remember that we did own Snowflake briefly in the spring, but we didn't have it for too long. We actually decided that it really was not a good fit in our portfolio. We sold out of our position and allocated those proceeds to AppLovin, amongst a few other things, which turned out to be a fantastic deal this year. But we're going to discuss why that is. We'll talk about Snowflake. We actually do not hate on Snowflake. So if you're watching this and you're already upset at us, don't be. This is just going to be a fact finding mission into enterprise software.
Some of you have started saying in the comments, like, don't wolf speed or Navitas or Intel my stock. We're not going to do that with Snowflake. I mean, not that we could. We don't have that kind of power. But anyways, enterprise software in general. Let's maybe tee this up, Casey, with a couple of important points.
But before we continue, quick word from the sponsor of today's video, public.com. They have a new bond account that could get you a great deal on your uninvested cash.
That's right, especially if you're an investor where you want perhaps some income generating investments, some things that'll exhibit a little bit less volatility than the stock market at large, especially a stock like Snowflake, which is going to be highly volatile in the years ahead. A bond account yielding well over 6% after the recent sell-off in the bond market could be a great place to put that portion of your portfolio.
Do remember that your rate is not locked in until you invest. So check that out at public.com/CSI. You can see what the current rate is and get your cash invested in that new bond account. Public.com/CSI. Link in the description below.
So we actually, over on Semiconductor Insider on Discord, did an article on Snowflake at the end of November 2024. And we talked about the rally was probably deserved after Snowflake's Q3 fiscal 2025 update, but posited that we thought this rally was going to fade. And sure enough, it has a bit. It's back where it was in the first quarter of calendar year 2024. So the Q3 financials on the surface were very good. Snowflake reported 29% year over year product revenue growth, which is good. That's a positive thing for Snowflake as they kind of navigate this new world of accelerated computing hardware and new, very, very large data consumption needs of their enterprise customers.
And this is good because enterprise software as a service companies are really starting to finally get that long awaited boost from AI. We've been waiting for that boost because remember that accelerated computing and AI does not mean automatic boost for enterprise software as a service companies. And when we say AI, what we're saying is accelerated computing, meaning a generative AI and the new batch of machine learning breakthroughs over the last couple of years.
Yeah, thanks NVIDIA for that. But to Casey's point, this not being an automatic boost for a company like Snowflake, one positive they do have is they do have this consumption-based model. Snowflake actually is not a pure software as a service company. So that's a positive for them. They're already ready for this new paradigm shift brought on by accelerated computing hardware, where consumption-based pricing is going to be more important for price-sensitive customers. We also think things like perpetual license revenue, pre-cloud based revenue business models could actually make a comeback. We're working on a separate video addressing this with NVIDIA and Pure Storage and some other businesses, Broadcom, that have a lot of IP-based revenue that really lends itself to this old perpetual licensing revenue. The key point here, though, is companies like Snowflake that over the course of the last decade have come to rely on the new SaaS-based business model have some adjustments that they're probably going to need to make. And ultimately, all of this is going to cost quite a bit of money. And this is what we have continued to see play out for Snowflake in particular.
Yes, back in September, Snowflake sold just over $2 billion worth of convertible notes or debt to address the costs that they have currently, including a much needed stock repurchase to offset some of that stock-based compensation that's been going on. Take a look at that bottom line we have highlighted in orange there. You can see the share count for 2024. This is on a GAAP basis. The share count has risen about 2% compared to where it was last year. And this is on a non-GAAP basis. You can see that the share count has peaked at the beginning of calendar year 2024, fiscal year 2025.
And this is where things really have gotten tricky for companies like Snowflake. Software, historically, the beauty of it is asset light. They don't have to spend all of that money on AI infrastructure, on data center, computing infrastructure. They can tap into that infrastructure that are built by their partners like Amazon AWS, for example, in Snowflake's case. But where they lack spending on actual hardware and infrastructure, this is the problem. Stock-based compensation needs to get paid to those employees. They need these people that have experience and that know how to work with that new accelerated computing infrastructure. And so this is a big reason why stock-based compensation, SBC, continues to be on the rise for a company like Snowflake.
But here's the dilution problem in the cash flow statement. You can see stock-based compensation is rising at a slower pace than in years past, but it is still quite high. Depreciation and amortization are also higher. That's related primarily to the higher spend on equipment and infrastructure, again, AI equipment and infrastructure. And this results in the operating income growth being basically non-existent this year.
Yeah. Not a great situation for Snowflake. And this is why we said that the rally after Q3 was probably warranted for Snowflake, but told our community on Semi Insider not to get too excited just yet. And let's take a look at this further. Here are the other two portions of the cash flow statement: investing activities on top. But the first one in orange, CapEx, that little bit of spending on property and equipment, on the AI infrastructure, a small number, as well as the development of internal use software. These are the two line items you subtract from operating cash flow in the last slide to calculate free cash flow. These are both small and manageable numbers, but let's drop down to the cash flows from financing activities. The second box there on the bottom. This is the third part of the cash flow statement and important for Snowflake as it manages the bigger part of the equation, and that is the hiring of new employees that know how to work with accelerated computing infrastructure. To offset stock-based compensation to those employees, they had that big over $1 billion worth of stock repurchases in Q3 fiscal 2025 alone. That was the biggest reason they needed to take out that convertible debt.
Besides the stock repurchase, Snowflake has also used that debt to make an acquisition. In November, they announced the acquisition of the data integration platform Datavolo. Perhaps by Q4 fiscal year 2025 or Q1 of fiscal year 2026, we'll see the purchase price for this company.
Is it really Datavolo, or is that just your Italian practice on Duolingo coming out?
Oh, I don't know. Maybe it's Datavolo.
I think Datavolo sounds much better.
What is it?
I don't know. Let's go with Datavolo. I like it. Okay.
It's probably not, now that you say that.
We're going with it. The name's going to go away. It's becoming part of Snowflake.
It's like of the table. Anyway.
Language jokes. Okay. So this is probably a much needed acquisition. It's all kind of on the back end infrastructure side, not very sexy if you're an investor looking for fireworks. This Datavolo acquisition gives Snowflake the ability to offer developers using their platform more flexibility in how they manage the flow and the growing amount of data that they need for things like training AI and machine learning and all sorts of the nice fancy stuff that is coming out these days. So like Casey said, stay tuned. Early in calendar year 2025, you should find out what this actually cost Snowflake and probably get some more insight into their spending trends for the next fiscal year that coincides with calendar year 2025.
Ultimately, the point is Snowflake is having to shell out a lot of cash right now to get the business into an AI era shape. The balance sheet for Snowflake is in good condition. You can see that they have a fantastic cash balance, over $4 billion, but they do have that debt now. And this balance sheet does not include the acquisition of that Datavolo company.
Okay, so there's some of the positioning that Snowflake is in as we start the new year, the new calendar year. But let's talk a little bit about valuation here because things have gotten messy. Let's focus on that all important free cash flow per share metric for Snowflake.
Snowflake is growing fast and faster than it was at the beginning of this year. A 30% year over year pace is really great. And it's going to offset some of those dilution effects that we've just talked about and justify the valuation. But even right now, Snowflake is mature enough to be able to manage that free cash flow on a per share growth basis. You can see currently 27 cents free cash flow per share at the time of the last earnings report. The only problem, free cash flow per share has really stalled out on a quarterly and annualized basis this year.
Yeah, and you can see that here on this next slide, the annualized free cash flow per share over the previous reported 12 months, that's through Q3 fiscal year 2025, the report that we got in November, no growth on a free cash flow per share basis. Perhaps when they report their next quarter to close out fiscal year 2025, they'll get a little bit of a jump in this metric. But to really justify this stock's recent rally and to sustain that rally into calendar year 2025, investors really should be paying attention to this right here. Free cash flow per share growth. Snowflake is very much of sufficient size at this point that this needs to happen. I know there's a lot of expenses taking place to get itself in shape for the AI era, but sooner than later, this metric needs to return to expansion mode if shareholders want to see appreciation in the stock price.
So that leads us to the question, if we're not adding Snowflake to the portfolio, what companies are in our portfolio?
So if you missed it, we recently did an update on Salesforce. We explained how that even ended up at the top of this non-chip stock holdings list for us. We did take some profit off the table and move that down the list here. But we also explained why we thought Vanguard IT ETF, one of our long-term ETF holdings, looks like a great place to invest this year. If you think enterprise software businesses are going to start to get a little bit of a tailwind from AI. To summarize it for you, yes, VGT ETF is stilted towards the large mega cap technology businesses, but you have that long tail of several hundred mid cap and small cap businesses, many of which could get all that same tailwind this year. And so I think ultimately what we're thinking this year is we're starting to get out of this era where very specific stock picking is the best route to go. And especially if you're a newer investor, it's going to be really important to just get some diversification into your portfolio. There's broad expectation that the whole market, the S&P 500, the NASDAQ composite, gets a really healthy increase in earnings per share growth in calendar year 2025. And so this is that rising tide that will float many boats. So we think a holding like VGT is appropriate for this year, especially in the crowded software market. So that's what we're looking at right here. And of course, Snowflake is one of those holdings. Depending on market fluctuations each day, it's usually between holding number 30 and 40 in Vanguard IT ETF. Now, that's not to say that we're not going to be investing in individual stocks anymore this year, but we'll put those videos out as we see opportunity arise as the year progresses. So yeah, Snowflake, we're not dogging on it, but there are still headwinds.
You're not wolf speeding Snowflake.
Wolf speeding Snowflake, but there's a lot of headwinds still that will persist for a lot of enterprise software businesses.
Thanks everybody for watching this episode of Chip Stock Investor. Make sure you sub to the channel, like the video, share with your friends, and check out Semiconductor Insider. As Nick said, this specific topic came out about a month ago on Semiconductor Insider for our members. Link in the description below. You can join us on our Ko-fi page. See you all again soon at Chip Stock Investor.